So we are going to go over a 30-year-old young entrepreneur in this video. We're gonna have fun with this one. This is one of my favorite topics to talk about because I love business and entrepreneurship, and I'm not 30 anymore. I'm a little past 30. When the date of this video, I am 32. So times are moving, been in the industry almost a full 10 years. But entrepreneurship and cash value life insurance. So the purpose for using money here, two main reasons. One reason is the core benefits of a cash value life insurance policy. It is a safe, liquid, tax-free area to position money, but the key area of interest here is money available for my business. One, I want to put money somewhere other than a bank account where it is still very liquid. That's the appeal to a bank account, why people like storing cash, stockpiling cash in that sense. Cash cow, we could call it. I've got access to cash because the greatest investment is in myself as an entrepreneur or a business owner. When an opportunity comes up, if it's pumping money into marketing, if it's renovating a piece of property, a building for more office space, whatever it might be, hiring more people, that's one of the best investments you can make, by the way. Whatever it is, having money available for that is critical because that is what allows you to move forward very quickly. So what we're going to look at here on the funding, two scenarios. So one thing I appreciate when I'm looking at any product is options. So we are going to look at a scenario where he pays into a policy $50K per year for 15 years. And then also we hear this quite a bit where individuals will state, hey, I don't want to have to pay into this thing for a long period of time. I love the idea of getting a big bucket of cash, a big pile of money into a policy and just letting it float, appreciate over time and use it almost as a personal line of credit. So the second scenario we are going to look at is $100,000 per year for 5 years, a total of $500K. You know, there's a young entrepreneur, he actually works for Grant Cardone, he's one of the top guys down there, where just in speaking with him as he was looking to open a policy, one of the things he mentioned was, you know, I like the idea of just having a big pile of money in there floating. So as opportunities come about, if I decide to invest in my own real estate, whatever it might be, having a big bucket of cash there instead of money in the bank account, I'm attracted to that. And looking at the guarantees, the internal rates of return, the net performance, that is what really appealed to him. And it's what appealed to me as well when I studied this product, say, okay, here's what big banks and corporations do. They optimize the cash value and they beef it up early. A lot of times you will hear the objection, hey, I don't want to have to pay into it for a long period of time. Yes, if I can continue to feed it, that's great, but show me how I can stop in a very short period of time. So the policies are going to be designed for maximum cash value. Now on this point, this is very important for an entrepreneur or a business owner, same thing. Policy design, here we go. So when it comes to the policy design, we talk about this frequently. Where's my money going? Where can it go? The premium or the PUA component. If I want to put in $100,000 per year, I'm age 30, I cash flow typically positive, but there's some months that are much slower than others. Do I want to receive a bill for $100,000 every year? Probably not. So if I can design this insurance policy in a manner where I can use it more like a flexible savings asset, so I'm 30 years old, how do I design it where I'm not committed or obligated to that $100,000? What we can do here is design the product where I am committed to $10,000. That's my minimum commitment. This is an amount, if I'm looking to pay up to $100,000, the $10,000 per year is likely very easy for me to swing. I can pay that no problem. Whether I pay it yearly or monthly is completely up to me and the insurance company I select, depending on how much flexibility I want. And then I have the ability to throw an additional $90,000 per year into PUAs for a total of $100,000 per year. This way, I have the ability to go up to $100,000 per year, but I am only committed to the minimum $10,000. Now I am using the product like a flexible savings asset. Safe. No relationship to the stock market at all. Liquid. Can access it anytime I want. Money available for my business. And then the tax-free component becomes more and more attractive as my business grows. Once I pay off all of my debt or debts I'm leveraging perhaps, eventually I'm going to have to deal with what? The thing everyone hates, paying a lot of money in income tax. So having money in a tax-free savings vehicle is not a bad thing by any means. And I've got a death benefit as well. I'll tell you personally, when I started my policies, the death benefit was not a concern to me. I was 23, 24 years old, first policies I had, and I was not concerned because I was a single guy, lived at home, like I don't need the life insurance. Now I am very happy to have the death benefits I have intact. In the event anything does happen to me, my wife's taken care of, which is extremely important to me. So the death benefit became more and more valuable as time has passed. But of course, I've got the cash value, and that's the reason why I pump a lot of funds into the policy, or I should say have the ability, going back to that point, ability to pump a lot of money into the product. So let's look at the options now. I have talked enough. Let's have some fun. So first things first, we're going to look at 30-year-old entrepreneur, $50,000 per year, going into the product for 15 years. And talking about options. So I do like to show more than just two options, typically when we work with individuals. Here we're going to show two options with the same company but different products. And this is good to build consumer awareness. The last thing I want is to purchase a product and then find out after the fact a different option existed, but Steve never showed it to me. Now I have a problem. Steve, why didn't you show me this? I think I would have preferred that. Come on, man, what's up? So on the left, we have a traditional whole life insurance policy geared for strong long-term performance. So if we go back to the core fundamentals of policy design, money can go where? Premium, or the PUA component. With these two options, we have a 10% premium on the right and a 10% premium on the left. 90% PUA on both options. Both products are optimized for maximum cash value from start to finish. Start is very critical for an entrepreneur trying to get things going. If you own a business or have run a business before, the hardest thing on the planet is to start. Getting things going in the beginning, when you do not have that experience, that capital is very important. And if you're at a point where, okay, you're starting to cash flow now, you've got some excess funds, but you don't want to go too illiquid. If you say, okay, I'd like it there, I probably don't need it, but just in case, right? Because I remember how much it stung in the beginning trying to get things going. You can tell I get emotional about this stuff without even getting to the topic because it was a struggle in the early years for me. For a lot of business owners, when you take that plunge, it takes time to get things going. So my point to mentioning that and getting emotional Steve here on you, is traditional whole life insurance products. What happens with the base premium piece, the insurance expense, in the first 2 years? The company overcharges me for the base premium in year 1 and year 2. That is why if I have $50,000 going into the traditional whole life insurance policy, $5,000 of which is going toward the base premium, I do not see that $5,000 show up in cash value in the first year or the second year. This is also why in year 3, and it doesn't matter on my age here, age has nothing to do with this, year 3, I pay in $50,000, still $5,000 is going toward the base premium. Cash value grows by $51,000 that year. The base premium is now beginning to come back to cash value or build equity for me. That is with a traditional whole life insurance policy. The minimum base premium, which is 10% in this example, is not showing up in cash value in the first 2 years. Compared to a high early cash value product, a bit different here. With a high early cash value product, the company does not overcharge me in the first and second year. In fact, you see, of that premium, regardless of the dollar amount, about 90% of it shows up in cash value in the first year. And then money I funnel into PUAs are more cash value on top of it. Very cash rich. A lot of business owners and companies like these type of products, or they always like to be presented them, I should say, these products presented to them as a business owner, because it does not negatively impact the balance sheet as much as a traditional product. I pay in 50, I've got close to 48,000 right off the bat, and a death benefit. The death benefits are identical on these examples. About $4,000 more. If I was looking to pay in $500,000, it'd be about $40,000 more. So there is a difference there. Good to be aware of that. And as a business owner, my question is going to be, what can I do with the money up front, not only in the first year, but look at the first 5 years. How much more do I have? $10,000 more in cash value on the example on the right. What can I do with the money in order to continue to grow my business or outside investments, whatever I'm using it for, paying off debt? What can I do with it in the meantime? And what I can do with it, will it outweigh the benefit that the product provides over the long haul? That's the question here, which if you're a business owner, you already know that. So as time passes, what happens? That high early cash value product becomes less and less appealing. The reason why is where we mentioned the company does not overcharge me for the base premium in the first and second year. They credit most of it up front. What they do is spread the insurance expenses out over the life of the policy, and what ends up happening is that it's actually a bit more expensive. Same dividend rate, same health rating, everything's applied here, but slightly higher expenses, which results in a lower net cash value. So you see, as time passes, the cash value difference here becomes greater and greater in favor of the traditional product. And again, this is why options are beneficial. Have you ever been presented a whole life insurance policy and you see one product with one company, maybe two? This is where looking at a number of companies, products, understanding the flexibility features, it's very valuable. And it's a lot of information. We don't want to be overwhelmed or feel like we have to take in everything, but we want enough information where we can make an educated decision, and then we can use the product to the fullest degree from a maximization standpoint and also usage. How do I use it to invest in my business and such? Which usually we go through policy loans, but not in this video. So there's the difference in cash value performance. Break even, year 3 with the high early cash value, year 5 here with the traditional product. And these are with the same company here. So again, the question I'll ask here is, when I see this cash value difference up front, is if I'm paying money into the policy, I'd ask myself the same question. If I'm paying money into the policy, the additional cash value I have with a high early cash value product, more cash up front, do I need or do I want access to that additional cash value? If the answer is yes, that's likely the product. Because if I go the other route and I'm thinking, oh man, I wish I had that, then I'm always thinking about it. Maybe I've got anxiety and it's like, I don't want to go that direction. I've got to do what works for me. Not what everyone else recommends. We can take the recommendations, but what works for me in my particular situation. So here, do I need access or want access to that additional cash value? If I say, hey, I'm paying in 50 grand per year, and by year 5, I've got 262 over here, 251 over here. Realistically, I'm not going to need that. I might pull out 100,000 max over the first 5 years. If that's my position, this one likely made more sense because I'm not going to need access to every penny, and I can reap the long-term benefits as well. Just questions to ponder. Think how I'm actually going to put the policy in action. Do I plan on using it aggressively early on, or do I plan on utilizing it as a safe, liquid, tax-free area to position money that, hey, if something comes up, I have access to the capital, but I'm probably not going to need or want access to every penny in it. Just ways to approach the situation. Let's look at it long term. Always good to do that. How about age 80, 50 years down the road? See a difference here. Almost $400,000. Consumer awareness. I didn't know I could have that option. That's what pops up all the time. Let's look at the 5-pay scenario. So this is very attractive. Personally, I like this option for myself. Being able to hyper-fund it in a short period of time, the option to keep on adding money to it if I want to, but getting a pile of money in and then stopping. A lot of people are attracted to that. I am as well. A lot of people who are older really like this option as well, in their 60s or 70s, to say, hey, I've got a lump sum of money. I just want to get it in there and that's it. Maybe I'll add more, but probably not. Anyway, 2 companies here. Limited pay products. So we used products here that are geared for maximum long-term performance. No high early cash value product in this option. Here is a product, so this is a limited pay product. The thing I don't like about it is even when we maximize it, $100,000 in, almost a 20% hit right off the bat. Break even for a healthy 30-year-old, year 6, which is on the tail end of typically what we should expect with a well-designed policy. If we're older, this particular product, it's a limited pay product. We'll have more information on it in our membership program and agent training program. We'll provide all the details there. But with that product, if we're older, typically breaks even between years 6 and 7. That's the drawback. And again, like that high early cash value, do I need or just want to see it, want access to more of what I pay in upfront? The advantage on the flip side is the long-term performance. So here we've got the annual internal rates of return, not the average, the annual. What am I earning each year? Looks strong. It is strong. This is a whole life insurance product. And again, if you're an agent and you have questions on this, would like to see the actual illustration, this is the kind of stuff we cover in our mastermind calls as we model the policy in the actual software with those subscribed on the ILS Training Academy. So strong internal rates of return over time. Then we've got company B, similar product, richer cash value up front, $100,000 in, $89,000, almost $90,000 year 1. Same limited pay product, or similar limited pay product, I should say. Difference is they credit the equity up front, breaking even between years 3 and 4. There's my internal rates of return. Strong policy. Cash value difference here, we see company B is stronger out of the gates. Come on, there we go. Eventually, company A catches up with it at age 65. And here's the thing, I've mentioned this in other videos, in prior case studies. If I'm looking at illustrations and comparing companies 30, 35 years down the road, I don't want to say it's useless, but it's almost useless. And the reason why is when you look at actual performance on whole life insurance policies, specifically with the 4 major mutuals, I've seen this consistently, Mass Guardian, New York Life, and Northwestern Mutual, we've seen them deliver strong cash values in reality, not just projections. We're talking policies that we obtained dating as far back as 1975, but more recent we've seen, okay, over the past 30 years, here's the net internal rate of return, what they've actually delivered, and regardless of what that original sales illustration projected, we've seen those top 4 companies almost always go back and forth with each other. They all say they're better than each other, which is somewhat natural from a competitive standpoint, but we've seen each of those carriers produce strong, optimal cash values. So there we go, limited pay scenario. Let's look at the last option here, because this was very, very attractive to myself and another individual in his early 30s that looked at a similar policy to this, $500,000 for 5 years. And what the individual mentioned, he said, Steve, like the guarantees, that's what I'm interested in when I look at this. If it does better, that's great. But I've got my profession doing well right now. I have other investments. My real estate investments produce stronger internal rates of return right now. However, I do like the liquidity of this and also the guarantees. It's almost like an alternative to a bank account, really is how he's approaching it. And looking to get married soon, the death benefit's going to have more value there as well. So $100,000 for 5 years, nothing thereafter. And this is guaranteed values, absolute worst case scenario. Look at that. Annual internal rate of return. By the way, what are the core benefits to a cash value life insurance policy? Safe, liquid, and tax-free. If I'm in a high tax bracket and I'm doing over 3% tax-free in today's low interest rate environment, that is great. Now, these illustrations in this video is prior to the new tax change or prior to the insurance companies updating their products with the new tax law change. We'll see exactly how that plays out. We've got more information on that. But right now, and for some time now, we'll see strong products here. Strong guarantees, absolute worst case scenario. Even though life insurance companies, especially the 4 major mutual companies, have operated in a non-guaranteed environment for the past 150 years. I got that from Scott Witt. He's an actuary that I like to talk to on occasion. We have podcasts with him, and he's a fee-only insurance advisor that really specializes in consulting with his clients on how to maximize the cash value of a product, whether it's just accumulation or if my goal is to take income down the road, studying the company, the product, the design from an actuarial perspective. He knows what to look for, consults individuals, and he lives it himself. Has policies that have performed well, but he's a to the point, very, very sharp guy. Scott Witt, that is. But overall, strong, solid options here. So this one was a ton of fun. As we build the policy, right, we've got our different funding options, how to maximize the cash value. What we did not look at in this particular case study was loans. How to borrow from it, and what's the impact on policy loans. We'll see that in future videos. If you looked at other case studies, you've seen that we've touched on it on quite a bit of them, and they're almost all the same, but it is something that is beneficial to look at as well. So as always, I do hope that this helps. If you have any questions, reach out anytime, and we'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.